Welcome to our weekly Ask the Fund Manager series. The premise is simple. We put a fund manager on the spot and we ask them questions about current events and how these events impact on investment markets. We aim to keep it interesting and understandable and do this all in under 5 minutes. We hope you enjoy.
I can't believe that we are already a quarter of the way through 2026. It just blows my mind. And it's been quite the ride for markets. So at the beginning of this year, we had this house view that geopolitics was potentially going to drive markets. And in reality, in January and February, that really wasn't the case. Big on the headlines, but there wasn't a market impact. But that changed in March. Geopolitics started to impact markets. And that's what we'll unpack a lot today. So, Sotirios, what are the three key themes that were driving markets in March?
The three key themes are, of course, the conflict we had in Middle East. That led to a very significant increase in the oil price and potentially a severe inflation shock, which then led to a lot of market volatility. So it's very clear that these three themes are all connected. And they're different to the other months, as you mentioned. Greenland didn't move the markets as much. Venezuela didn't move the markets as much. These are different. This is different this time because of that mechanism I just described. In March, geopolitics dominated everything, including asset markets.
Okay, so let's get straight into it. So why then? What happened in geopolitics that made it problematic for markets in March?
Well, obviously, we had the Middle East conflict, which escalated very significantly. And then the markets very quickly shifted their focus on the risk of energy supply disruption, particularly through the Strait of Hormuz. We know it's effectively been closed for over a month now. That route is very, very important because roughly a quarter of the world's seaborne oil moves through there, and therefore the disruption hits confidence very, very quickly. Once confidence is hit, then the market starts to focus on headlines and what are the signs of diplomatic resolution, what are the signs of worsening escalation. So that has led to quite a lot of uncertainty and a lot of markets volatility that, of course, affected returns.
So on returns, I'm just thinking about oil prices. So oil, we've talked a lot about oil this year. So what has happened to the price of oil and how does that feed through to inflation?
So, of course, the oil and gas supplies have been seriously disrupted, as I mentioned, and that has been feeding through the pricing. So a barrel of oil was costing roughly $65 prior to the war, and now it's closer to $100. This is a very, very big move. Just to put it into context, a sustained $100 price per barrel will knock out roughly 50 basis points of global growth. But at the same time, what is very, very important is that it also pushes inflation higher. That creates a very difficult decision for the central banks. Before the escalation, just to provide some context, the central banks were pricing cuts. So if you look at the Bank of England or if you look at the Fed, the base case was that they will probably cut interest rates. Now we have moved all the way to pricing hikes, particularly in Europe. I think the base case is that they will be hiking rates if this inflation shock persists. This is very difficult because at the same time, we're going to have a weaker growth, as I mentioned, due to the demand destruction that might come through the oil price. So hiking rates into a recession is a very difficult proposition for any central bank. So that's why I mentioned before that geopolitics dominated, but that moved into the oil price and through the rates pricing for the central banks. And that created a lot of volatility in markets in March.
That seems to be it, isn't it? That's the part that makes geopolitics problematic. It's when it starts to impact inflation usually through oil. And that's basically what we saw in 2022, and we know that was a difficult year for investors and markets. So with that in mind, what's happened, what's the impact of markets so far? And actually, even more important than that, how do you deal with that as a fund manager?
Yeah, very good questions. I think March was a very difficult month, of course. We had equities down roughly 60% if you look at global indices. And at the same time, there were very little safe haven. Gold didn't work. Bonds were down on the month because of that hike premium that was getting priced by the central banks, by the markets for the central banks. So I think it's very, very important to take a step back in periods like this and almost think about, we don't want to overreact to headlines. It's very important to remain patient. As Warren Buffett puts it, the stock market is a device for transferring money from the patient to the patient. So we do focus on the long-term themes. We use scenario analysis by providing from independent experts to understand what could happen next, but more importantly, we stay patient. And at the same time, we're ready to act if we notice dislocations at times that markets, for example, shows real signs of stress.
And we always conclude on this side of the month, and it links in with the idea of being patient, which is there's a study from Morningstar where over the last decade, investors earned about 1.2% less per year than the actual investments that they held, and that was purely down just to mistiming the buying and selling of those investments. So the kind of the read through is there are times that the enemy isn't always volatility or market sell-offs. The enemy is our own cognitive biases, the acting irrationally and being patient and not reacting irrationally to those market events is really, really important to get the returns that people need. Sotirios, thanks so much for your time today, and of course thank you everyone for watching, and we'll be back again next week with another episode.
Thank you for listening. We hope you enjoyed this episode, and we hope you listen in again next week. Also, we love to get feedback and ideas for future episodes. You can use the link provided below to share your thoughts. Before you go, just some important information to be aware of. Unless otherwise stated, any opinions expressed are those of Aviva Investors. You should not be viewing this as an indication of any guarantee of return from an investment managed by Aviva Investors, nor as personal advice of any nature. Information contained herein has been obtained from sources believed to be reliable, but have not been independently verified by Aviva Investors and is not guaranteed to be accurate. Past performance is not a guide to the future. This material is not a recommendation to sell or purchase any investment. The value of any investment and any income from it may go up as well as down, and the investor may not get back the original amount invested. Nothing in this material, including any reference to specific securities, asset classes, and financial markets, is intended to or should be considered as advice or recommendations of any nature.